everyone. I'm Rick Bensignor. Today is Tuesday, October 25th, and welcome to this week's In the Know Trader Show. Today in our trader education portion, we're going to take a look at and talk about what to do when you just miss your entry point and the market starts moving away from you. And then in our sector focus, we'll take a look at a sector we have not looked at in quite some time, which is S&P Industrials, different than Dow Jones Industrial Average that we did last week. So this is S&P Industrials. So we'll look at that through the XLI ETF. We'll look at it on its own versus the S&P. And then we'll take a look at the top 10 holdings of the XLI index. And just while we're talking about that and introducing the idea here of what we're going to go over this week, when I show you the top 10 holdings in the XLI, so there are 71 names in the XLI, the top 10 make up 41% of this ETF index. So 1/7 of the names, about 14%, make up 41% of the weighting, which is why any of these S&P cap-weighted indexes, the S&P 500 itself, all the subsectors, etc., the macro sectors, they're all cap-weighted, and therefore we generally look at the top 10 because they make up a significant portion of that ETF's total weighting. So here are the names. You can see Raytheon, the most important name in the XLI, over 5%. Honeywell just shy of 5%, along with UPS, Union Pacific, and then you get lower ones. But even getting down to Northrop, the 10th ranked weighted name, is still about 3%. And obviously everything else is less and not as significant, but these top 10 make up essentially 2 out of every 5 names. And that's why if you have an opinion on industrials, you essentially should have an opinion on these 10 names because they are really the bulk of the weight of what you're looking at. All right, let's talk about, actually, before we do that, let's just, let me remind you of the products that we have here at In the Know Trader. So we have a weekly ETF Tactical Trader Report, goes through the essential elements of what you need to know about the current status of the U.S. bond market. In other words, where rates are and where they're likely going next. The U.S. dollar, some commodity markets, often gold or oil will show up in there. And of course, a deep dive into the S&P each week, my thoughts on it, which way I think the market's going, and key levels to play off of. And then I put out a new ETF trading idea each week too, as well as walk you through every open trade we have from prior weeks until we close them out. That generally comes out Thursday evenings. And the other product we have is called the 7-Eleven report. That comes out once a month on the last trading day of the month. If it's a weekend, it'll come out over the weekend. And what I do here and design this to do is outperform the S&P by being in no more than 7 of the 11 Spider Macro ETFs. And with the goal here, beat the S&P and avoid the 4 underperformers, or what I think would be the 4 least good performing sectors at any given month relative to the overall S&P. So this is 100% invested at all times across the S&P, but just not fully across the S&P in no more than 7 of the 11 sectors. And to see how we're doing this year through September 30th, the last time we've updated results, we are outperforming the S&P by 408 basis points this year, outperforming 8 of the 9 months of the year. And we've outperformed the S&P by a little less than 9% in the total history we have since August of 2020. And as I've said before, this would put us in the top 10% of all people who tried to beat the S&P. So subscriptions are available at no more than $87 a month, and it can be quite a bit less depending upon if you package them with the ETF Tactical Trader Report, as well as the length of your subscription. And I will tell you, not because I do this, but if somebody else showed me a product like this, fully disclosed, where every single month the total track record from day one is displayed, and showed me that they are fully invested in the market and outperforming by over 400 basis points this year, and over 8, almost 9% in just over 2 years, I would say they have one heck of a good product, and something very much to pay attention to. So rather than just simply buying spiders, this will give you, or at least in the past has given, a far greater return than investing in the broad index of the S&P 500. If you're watching this, you're probably watching this through my YouTube channel, but if you haven't signed up yet to subscribe to it, go to youtube.com/InTheKnowTrader, click on the subscribe button, and then all my recent videos will pop up when you go into and sign into your YouTube account. And of course, occasionally I tweet on Twitter, so follow me at InTheKnowTrader.com. Okay, so let's now get to this week's subject, and that is what to do when you just miss your entry point. And, you know, this can happen a fair amount to traders, where you have a certain bid level or certain offer level, and the market gets close to it, and you're anxious to get filled, and it just doesn't quite fill you, and then the market goes and turns around and goes the opposite direction. And you have a decision to make as a trader, whether or not you should alter your entry point, or simply stick with what you have, or possibly just get in at current prices and say, you know, all right, I missed it, but I think the idea is the right idea. So let's talk about this. And I'm actually going to pull up a chart here. We'll look at the S&P Industrial, the XLI, the S&P Industrials, and this isn't quite current. We'll get to current, but let's say, you know, this is the picture we have as of what is that, mid-September, and you can see, you know, certainly multiple lows just north of 84 in that neighborhood. But you see that from 2020, there's a gap, and you figure there's a good likelihood the gap should get filled before this potentially moves higher. So let's say you were looking to get into this in a bullish manner, and you placed your bid either in the gap or even, let's say, at the bottom of the gap, because you made the assumption that if we're going to get this close to the gap, market will probably fill it before turning around and going higher. So this has us through mid-September. We're going to bring one more price bar or two more in, and you see we actually just touch into the gap. But let's say your bid was halfway into the gap and at the bottom of the gap. So we'll call that kind of 82.5 down to 82, and you kind of just missed it. And the next week shoots up to 88, but then pulls back and closes 85-ish, and you go, what should I do here? Should I stick? Should I not? One more week comes along, and again, we kind of get right back down. You just miss your entry point on a fairly wide range week that ends up closing down on the week. But, you know, now it's a few bucks higher than where you wanted to enter. So you wait another week to see what happens, and the next week opens higher, screams higher, and moves up. At that point, to me, if you haven't done anything, it's time to do something, because you had the right idea. The gap was going to get played with. You just happened by some bad luck to miss your actual entry. So I start looking at, let's kind of analyze the charts and think about what should I be doing at this point. And one of the things I'd look at right away is, let's take a look at the general support level. We know the gap could be support, but we look at the early 2021 low, and hold on, that line went the wrong way. So let's turn it out here to the right. So we see that got tested on the June lows, and then we have the big rally, and we come back and we just take it out, and now we're right away back above those June lows. So to me, that's enough of a sign that you should do something to get into this long idea, because you have the right idea, but you just kind of missed the entry. So when I see a week like bar one that opens low, so Monday's morning ends up being what ultimately was the low of the week, and we're trading up all week, it suggests to me that I can't be that finicky over 50 cents when the idea is playing out. We're back above those old highs. If I add, let's say, some of the models I use, so let's say now I look at a propulsion level, and I see the bearish propulsion level down here at 82.95, and we bounced off of it 2 weeks ago, and this, you're moving up. It's just another sign that that's probably the low. So to me, as a minimum, you need to get into some of this long idea. You may choose not to get into 100% of it, and that's fine. But I don't want to see you kind of do absolutely nothing, because for all practical matters, what you thought was going to happen has happened and gotten tested. And that level is clearly being rejected. So even if you buy a 50% position compared to if you were going to put, $1,000 into the stock, put $500 into the stock. Because if it keeps running away from you, then you've got absolutely nothing, and over a 50-cent miss in getting your entry point, you've missed the whole move that you anticipated. And then we look at another week, and that actually brings us, to real time this week. And you're seeing more gap up higher yesterday on Monday, follow through today. And to me, something like this, when I have a price I want to get into something at, and I've just missed, if I get any sense that it was really the right thing to do, and we're back above, let's say, a breakdown level, so that it's a quick breakdown. In this case, we finally took out that June low, and we come right back above it. I buy some. Again, I may not buy the whole thing, but I buy some, so I have some exposure, and I've done what I really wanted to do. So you can get really finicky about entries and exits, but when your idea is correct, but you just happen to miss your entry or your exit, this works both ways, adjust and play for what the market's telling you. So for those who subscribe to In the Know Trader, you know that right after we had that big down move in S&P terms, that ended up being the low, the day that made the low, down to 34.91. So we had a big update. Remember, that's the day we opened like 2% lower and then moved up and closed 2% higher. So we had like a 4% intraday move from low to high, and we closed on the highs. The next day, we were already buying the pullback. And to me, I was able to assess that I've missed my precise entry by a small amount, and I see that bad news bottomed the market, which is normally what happens. It's not good news. Almost always, it's not good news that creates the bottom. It's bad news. And this, in case, was an inflation number. The market was down a couple percent. And right from that moment, as soon as the New York Stock Exchange opened, where S&P's futures were down, 80 points, something like that, they turned around and closed up 80-something points or 90 points that day. I don't remember the exact levels, but I know we went from down 2% to up 2%. So the next day on the pullback, I was a buyer, and I've been bullish since then, playing for a shorter term up move, which has been here. If I, let's say, switch this to a daily chart, you can see, so here's that day that we opened low, closed high. The next day we bought the pullback, actually pretty darn close to the lows, And this has been the move since. So at the time I said I expected the market to hold up, like a short-term rally to hold up through election day. And nothing's changed my mind about that. I think we will still hold those lows that we made in mid-October through election day and possibly beyond that. But that was my call at the time, is that we'd have, that was the low I was looking for in mid-October, which I had called for in mid-September. We said we would likely bottom mid-October. And seeing the price action the way it played out made me feel like that's the right way to play things. So I'm not going to belabor this. I just want you to think about that. There are times you're going to miss your entry or exit point by a very small amount, and it's frustrating, and it's okay to give it another day or two or whatever time frame you're looking at that you judged that entry from. But when the market kind of tells you you're wrong in the sense to hold out for that level, adjust your thought process, get involved in some way so that if the market turns around and just keeps going the way you thought it was going to, you haven't missed the whole thing. You at least have some exposure. So that's my thoughts for the week on trader education. Let's now take a look at just the analysis on the XLI in overall terms, and I'll give you my thoughts on it here. So we use this as our example, so I'm kind of bullish on this move, at least through election day on, what is that, a week from Tuesday, a week from today. Is it a week from today? No, it's 2 weeks from today is election day, which I think it's the 8th of November. So I do expect this to hold up through there. And look, you can see when we look at XLI, we know that the last rally that we had after the June low failed against the bullish propulsion level. That has now come down to 97.79. It happens to be in the neighborhoods of the trend line again. And of course, depending upon how long it takes to get there, it'll determine how far much lower the trend line is. But this level is still going to be the level that I'm basically looking for resistance from. So I'd still say even at the current 90.5, you have something like 8% upside to reach the target that, again, I may very well lighten up exposure from. So that's XLI on its own. Now, let's take a look at it in relative terms to the S&P and see how industrials do against the S&P. And I've kind of put this chart in here too, where I've annotated a little bit of it. And here, let's blow this up a little. So here's your secular high back in 2018. And you can see it's been a downtrend, and you can see the downward sloping 200-week moving average here in navy blue. And we had a rally attempt that lasted about a year in a channel that then broke down. And now we've been in a channel for basically all of 2022. Now, it does have a minor upward slope to it. And we've just popped through the downtrend line from that secular high in 2018, but we're still kind of stalling up against here. And then you have the 200-week a little higher. So industrials are not out of the woods yet. And you'll see a lot of people on television talking about how well industrials are doing. But if you take a look at where we started the year, yes, they are outperforming the S&P, but it's not by a huge amount. And this is often a tough sector when it comes to the weighting game to overweight or underweight, because you have such diverse industries within industrials that they tend to often balance themselves out. So, you had the 2020 decline where everything that had any sense of growth or cyclicality got mushed versus the S&P because of COVID. And then it recovered and, kind of get hit again. And we had the 13.9 right before the bottom in fourth quarter of 2021. And again, the minor upward bias that we've had since. But this is not a clear case, gotta own industrials type of move right now. We're still up against some resistance. And, we'll see if it pulls back. I may be more inclined to be a buyer again towards, the lower end, but right here, right now, I can't tell you I necessarily want to go overweight industrials. So that's my view. Now, in relative terms, let's take a look at the big names that make up the sector, and we're going to start with Raytheon. So here's a weekly chart of Raytheon. These are now going to be all outright pictures, not versus the S&P, but just outright. So what are a few things that stand out? 2020 made its all-time high at the time, falls during the COVID collapse. We then recoup in the early part of 2022, even though the market topped in essentially January 1st, this went on to make new highs into April. But then we came right back beneath what those old highs were, sold off, and came right down to the TDST line here at 79 and change. The low of the move is 80 and a quarter. So we got very close. We bounced on the 200-week moving average, come back. There is going to be resistance above here in Raytheon from 92.5 up to about 95 over the next quarter or so. And so it's got somewhat of limited upside. I don't have a strong reason to think this is going to go and make new all-time highs. If I draw a trend line from the COVID low, let's see, did that break or not? Looks like no. So we held that. So, that's a good bottom down in here. We held trend, but you are going to have resistance up into the zone 92.5 to 95 or so over the next several months. So it's not a bad idea too, if you think about it, that knowing that there's going to be resistance here and knowing that we're still beneath what were the highs just before COVID hit, it increases to me the reason why to potentially take some profits there and look for a move down again, especially if you have questions about what the market's going to do next year and whether or not we're going to get a recession, which I think we will, and I don't think it's necessarily going to be a soft landing recession. All right, here is Honeywell. 3 points on this downward trend line, kind of similar to the S&P. Now, this didn't top at the beginning of this year. This topped in the middle of last year. It has broken beneath the 200-week moving average, come back, and you can see kind of, again, the wall that's in front of us. So you have a double bottom, a clear double bottom against, the summer lows. So the recent test down basically held right there, would come back, and we certainly could come and maybe even slightly exceed these highs and run stops. But same type picture. You kind of have somewhat of a wall here at 205 going forward for at least through year's end, or darn close to year's end. So let's call it 2 months or so. And you take a look at where this really broke down from too, and it's somewhere into this area. So same type picture. I'm not opposed on further strength to lightening, reducing some exposure in a name like this. Not particularly thinking that if we get to 205 that that we've broken out to the upside just because we took out the bounce high of August. I think you're still in the general range from where this broke down from. So another potential profit-taking name on a further rally. Here is UPS, bounce right on its TDST line, and you can see in this case didn't come from necessarily a non-obvious place. A lot of times these TDST lines, the lowest low at a 9 count up or the highest high and a 9 count down, come from non-obvious starting points. In this case, it kind of lifted off. This whole rally came from a place that also was not far from prior lows. But if you notice, we sell down intra-week, all but touch the 200-week moving average, come back up. This has resistance, let's call it right now for this week, 178 to closer to 178 to 182-ish, but going forward also through year end, just about what's that, 199.5 or so is the top of the weekly cloud, almost through the entire first quarter next year. So similar thing, I wouldn't mind taking some profits against those levels on a further rally. Okay, Union Pacific Railroad. So all-time highs in spring of last year. We sell down. We minimally break the 200-week moving average. You've got a 9 count and 13 count. This is a place that I could take, I think, probably small risk on doing some light buying here. You can either risk a new low or go all the way down to 174 if you want to before you stop yourselves out. I'm not sure I would risk that much, but I think you could potentially nibble, at least from a trading point of view, and aim for something like 213 between now and perhaps year's end. So that's a possible fresh buy. Lockheed Martin has done very well. All right, so we're back near all-time highs. We're playing with the TDST line right now. Remember, I just said 2 slides ago, the TDST line is either the lowest low in the 9 count up and often acts as support. Here's a good example. We did another 9 count up, so here's a TDST line, but more importantly is we did a 9 count on the way down, 9 consecutive Fridays, that the close was less than the close from 4 Fridays back. That gives us a setup 9 count and often a near-term turning point. We have, a month-long rally after that, test the low, even exceed it, and come strongly back. But here we are now against the highest high in that 9 count down. That's the TDST line. That's at 456 and change. We're trading right now 458, but the week's not done, so we haven't broken through this yet. Too early to tell. So obviously one of the better names near all-time highs. Same type thing. If you really have concerns about next year, you take advantage of this and you do some selling, maybe not as much as some of those other names that we talked about that we would sell into a rally. This happened all from last week, but still a place to consider. Maybe you take off 20% of what you have instead of 50%. Things like, again, adjusting to what the market's doing as well as what you might think over time. Deere. We get into an agricultural related name, which had done spectacularly well from the middle of 2020 as commodities rallied. Then you had the commodity sell-off, and they're still in the midst of a sell-off. And I'm going to show you something. Not only, I want to blow this up, but not only do we have the top of a very small cloud here, so it's not as meaningful, but look, if I take the cloud off, look where we are versus, here, I can do this. If I take this high from last year, we essentially have 1, 2, 3 times it failed there before eventually breaking through and then gapping down, coming back there and failing, coming back here and failing. Now, yes, there's an uptrend off of the lows, but same type of thing. You can make a case to do some light selling here. Just if you look at this price movement here, March, April of earlier this year as the anomaly, as the fake high that took shorts out of the picture. And then we, came all the way down and took out what at the time had been those lows. And then we kind of trick those people too, because you now wash out weak-handed longs only to come right back into the range. You're pretty much range bound and you're at the top end of the range. So not a crazy idea, again, if you have concerns about next year, to do some type of selling. I'm not saying get out of 100% of a position. I'm saying you certainly could take off some that you have on. And that's been a fairly consistent story across the industrial sector here of the names we've looked at. Here is now Caterpillar. All right, so we hold against the 200-week moving average. Obviously, we have one close beneath it. It goes right to the stop out level. These dotted lines are the risk level from this 13 downside exhaustion signal. So you'd have to properly get beneath this in order to say that you weren't close to exhaustion. At that point, we've come back here now. Look, this is kind of a flipping point. If I were to just extend this red line going forward, look how many lows it caught in the past. And it's the approximate area anywhere from, let's call it 190, 195 to, or 194 to 200 as being all these highs. it's not a bad place to consider potentially taking off a little. Let's now put a cloud up and see the clouds above us. Now it's a very narrow cloud going forward, which is better than having a thick cloud to deal with. So it's obviously it's a lot easier for price to break above a thin cloud than a thicker cloud. But somewhere here in the mid 190s is a place that, again, you could think of as the breakdown point and a place to consider possibly reducing some exposure. Certainly when I look back in time, you go back to 2021. So right now the move here above this red line, kind of where I have my cursor here, is February of 2021. So that's now more than a year and a half. It's almost a year and 3/4 that anybody who's bought Caterpillar is underwater. So there's overhead resistance. It's not going to just like scream up, or it's unlikely it's just going to push straight up, because you've got a lot of trapped people who might very well just reduce exposure, given the chance to kind of break even on a purchase that they've held for quite some time with no results. So something, again, to consider that way. Here's Boeing. Certainly one of the worst names we've looked at. We go back to where these lows were. And this year we held above the COVID lows, but one of the few names to really play or get close to the COVID lows. We did bottom on a setup 9 count. We then topped on a setup 9 count, and we're kind of caught in between here with the cloud moving down. You're literally where the conversion of baselines are from the cloud chart. There's no particular edge right here, right now in the name. So earnings are going to have a lot to do with how it trades going forward. But you kind of get a sense that you're in a sideways move. But in the bigger sense, we could at least say that we're closer towards the bottom end of this whole, not only trading range over the last 2 years, but since it made its all-time highs. So if I had to pick one way or the other, I'm slightly bullish, but this one's a tough one. General Electric, also one of the names getting closer to testing COVID lows. You see the TDST here at 45, almost $46. We have a double bottom above there at 60. So let's widen out the scale here just so we see what type of risk we have. All right, so double bottom this year, mid-range, playing with the baseline. We have not been above the baseline since really the very beginning of this year. So this orange colored line was resistance to start the year, resistance on the test in February, held here in the August rally. So playing, we're above it right now. Again, we're only on Tuesday of this week, too early to assess. But it would be good, the more we can close above. Right now that's 70.61 and it's trading 72 and change, so it's a couple bucks above. The more weeks we can close above here, the better chance it has to at least come back to either test the 200-week moving average, which is not, I don't think necessarily very meaningful in a name like this, but more importantly is will hit at some point resistance against the cloud. So double bottom between 60 and 65. Same kind of general area that we broke out from in the latter part of 2020. So good double bottom to play against, slightly bullish. And then last one is Northrop Grumman. This makes all-time highs this week. So this is the single strongest name we've seen. And despite the fact that this has lost some momentum for the last 6 months, the price surge last week is big, and this would suggest that you could almost pair this against almost any other idea as being the strongest name you can pick. Certainly any ones that were mediocre, this one should have a better outlook. So as a pair trade, in theory, a safer way of playing, take two comps. So take another defense name within Industrials, and pair it against, and maybe not Lockheed, because Lockheed was very similar looking. But if you go through the 71 names that make up Industrials, you should find some other aerospace and defense names that don't have quite as good a chart. So you would buy this versus shorting those as a pair trade. So that's it for this week. So it's only a week to go. You probably know if you're going to be in Orlando or not, but just as a last reminder, if you want to head down to Orlando or you're in the Orlando area, go to the Money Show. It is going to be the last time that I do a free public presentation on how to use cloud charts. Most of the information on how to use them is not correct, and most of the interpretation that you find on online and in books is all based on one person's interpretation. And I can tell you from being considered the foremost expert in the Western world on how to use cloud charts, it is not the correct interpretation. So if you're interested in hearing me come and talk on how to use cloud charts, come to the Orlando Money Show next Monday, October 31st. And if you are interested, if you follow this link here that I give you in magenta, if you sign up for the event there, you get a discount on the cost to register for the Orlando Money Show. So that's it. See you guys. Let's see, next Monday, will I be able to, next Tuesday? Yeah, I'll be able to do a show. I'll be in Florida, but I should be able to do a show from there. That's it, guys. Have a good week. Bye-bye.